Well, greetings everyone and welcome to the Argonaut monthly video covering August 2025. Now, as always, you can read about the performance of the two Argonaut funds, the absolute return and the flexible, in our monthly fact sheets available on the Argonaut award-winning website. And if you are an Argonaut unit holder, I would also encourage you to register for a client login so that you can gain access to a veritable treasure trove of additional data. Now, during the month, China hosted the first ever Olympiad for robots, where its boffins demonstrated that they had perfected the Manchester United style of association football. But the main financial and economic event of the month was the Jackson Hole Symposium, where Fed Chair Powell noted recent weakness in the US labour market may warrant adjusting our policy stance. The interest rate futures market immediately moved to price in an 88% probability of a September rate cut, with 1.5 quarter point cuts also now expected at the remaining two meetings in October and December. But this was somewhat overshadowed by the sell-off in rates globally, despite the prospect of Fed rate cuts, with the Japanese 30-year bond hitting a record high of 3.3%, 5.65% in the UK, the highest since 1998, 4.9% in the US, the highest since 2007, and 4.5% in France, the highest since the 2011 Eurozone crisis. Now, we're going to talk about some of the causes of this, focusing on uncertainty around central bank independence, particularly in the US. And as a special treat, we're also going to examine the latest troubles at Orsted, the Danish offshore wind farmer, which is the title of this month's video, Trouble at Mill. Now, President Trump attempted to fire Fed Reserve Governor Lisa Cook, previously appointed by Biden in 2022 for a 14-year term, citing allegations of mortgage fraud, which he claimed permitted him to remove her for cause. Now, Cook subsequently filed a lawsuit to block her removal, arguing that she wasn't going anywhere, that no fraud had been committed, and it was, in any case, immaterial. Now, aside from any improprieties committed by Cook, Trump has been vocal about his desire to have his own people in charge at the Fed. By ousting Cook, Trump considers that he would then have 4 out of the 7 of the Federal Reserve board governors. Let's have a look at what Trump had to say.
And we'll have a majority very shortly, so that'll be great. Once we have a majority, housing is going to swing and it's going to be great. People are paying too high an interest rate. That's the only problem with housing. We have to get the rates down a little bit.
Now, there's a distinction on the Federal Reserve between the Fed governors and the regional board presidents. Now, all of the Fed governors not only have a permanent vote, but a voting majority of them can fire any of the 12 regional bank presidents, only one of whom, the New York president, has a permanent vote without cause. Now, Fed Chairman Powell's term as chair is due to end in May 2026, and in theory he could choose to stay on as governor, limiting Trump's choice of a new chairman to those already on the board, although for this purpose Stephen Mirren's appointment is judged to be temporary. Let's look at the history of central bank independence. So, although the Federal Reserve was established in 1913, it is widely regarded as only becoming independent from Treasury through the 1951 Fed Treasury Accord that separated government debt management from monetary policy. From 1694 to 1997, the Bank of England, which was formally nationalised in 1946, only advised the UK government on setting of interest rates. Except for the German Bundesbank from 1948, European central banks did not become independent from government until the Maastricht Treaty in 1992 made it a formal requirement for entry into the single currency. So given their often disastrous experiments with quantitative easing, including buying up large parts of the government bond market, but also making capital more freely available to companies operating in favoured industries like the so-called energy transition, their inability to control inflation, and certainly in the UK under PM Liz Truss and in the US in Trump's first term, central banks have often courted controversy by taking up opposing views to democratically elected governments. Now, at the end of August, former UK Prime Minister Liz Truss made some interesting observations on the Bloomberg Odd Lots podcast. Let's have a listen to what she had to say.
They are far too powerful, in my view, at deciding what countries' economic policy should be, and they have not been effective. If you look at the Bank of England's record over the past 10 years on things like inflation, on economic growth, it's been extremely poor. And I fundamentally, why should democratically elected politicians kowtow to what unelected officials want when we're the people who are held to account for the successive failures of the policy?
So overall, it would be fair to say that independent central banks have been a recent experiment yielding mixed results. And when they get it wrong, unlike with governments, the electorate can't get rid of them. So they're unaccountable and not necessarily better than governments, but they are independent. So in the short term, it's hard to avoid the conclusion that any central bank move back towards government control will be greeted by market skepticism and an even greater allure for gold as an alternative currency. Now, although gold remains a popular trade, gold miners through a decade of underperformance are still largely hated. With our gold mining shares now trading at modest historic multiples and demonstrating better cost control of late, the fund remains well placed to benefit from their operating leverage to a rising gold price. And the current biggest position in the fund is Newmont Mining, the world's biggest gold miner, based in the US, which has nearly doubled in the year since we have owned it. Now let's move on to the main subject of the video, Danish wind farm operator Orsted, which surprised the market during the month by announcing a massive $9.3 billion equity rights issue to repair its balance sheet, which it previously denied was a problem. Now, this would represent Europe's biggest ever rescue rights issue, and the new capital would constitute 3/4 of Orsted's current market value. Now, our views are not an investment recommendation and shouldn't be regarded as such, but as many of our investors will know, Argonaut has been short Orsted since January 2022, when its share price was 800 Danish kroner compared to 200 today, and it was our biggest individual short position last month. Now, we've previously written extensively on Orsted and how offshore wind is a uniquely poor economic product, managing to rip off both electricity consumers. The UK has the highest electricity bills in the world, some 3 times more than the US, but without generating an economic surplus for offshore wind investors. Now, we intend to write in more detailed thoughts with interesting proprietary data in the weeks ahead, but since many of our investors have asked us our view, we offer the following as a taster. Now, one of the most glaring problems with Orsted is that any investor simply reading its annual report will find an amazing 114 pages of ESG guff, but almost zero disclosure about the 32 individual wind farm assets it owns and operates and is currently continuing to develop as long as investors cough up the cash. Now, if you are in the business of raising capital from investors to build projects which are highly capital intensive, it would normally be a good idea to give some examples of past successes. But failing to disclose and therefore avoiding scrutiny, Orsted is, in our opinion, trying to hide the truth, which is that even after government subsidy and regulation, the financial profitability of recently constructed wind farms is poor and declining, whilst older wind farms with even more generous subsidies, which will eventually come to an end, are seeing a higher cost of repair and operating costs, which will eventually be burdened also with decommissioning costs. Now, instead of allowing investors insight into the individual wind farms, Orsted Group accounts focus on accounting profitability measures like EBITDA and free cash flow to the firm, which take no charge for capital or debt servicing at either the wind farm project level or the group level. In other words, the accounting stinks. Through focusing on proportionally consolidated group EBITDA targets, it is possible for the Orsted Group accounts to suggest profitable growth without any of the underlying assets able to earn a return on capital, generate free cash flow, or pay dividends. Enron, which was the world's biggest bankruptcy in 2001, was, for example, a classic example of the misuse of EBITDA, going bust despite reporting record EBITDA, but with no underlying cash flow. It's time for the stock market and for analysts to wake up. Now, Orsted claims that the equity raise is largely due to their inability to farm down a 50% equity stake in its New York Sunrise project. In other words, there is no interest from any debt or equity investor in sharing the remaining $6 billion of capex for the project, which is stated to be 35% complete. Now, Orsted already has a checkered history in its inability to manage wind project costs in America. Since 2023, writing off over $6 billion of previous investments that turned sour, with build costs that are often double per megawatt of generation, those in the North Sea. Now, refusing to throw good money after bad, we note that in July 2024, US utility Eversource, Orsted's previous partner, sold its 50% stake in Sunrise to Orsted for just $152 million. Orsted told its shareholders that it had a good deal, but clearly this was too good to be true. Eversource perhaps realised that the writing was on the wall. Now, we think that the Sunrise project is a bottomless pit of shareholders' funds, but if Orsted walked away, it would not only incur decommissioning costs, but it would also put the neighbouring Revolution Wind project, currently subject to a presidential stop order, which is 80% complete, at risk, because Revolution and Sunrise projects share infrastructure and development. Now, with 2/3 of the equity issue, 40 billion Danish kroner, to be invested in the project, Sunrise, that is in our view not viable, the equity raised facilitates Orsted management's obfuscation around its US offshore wind strategy. This is a classic extend and pretend rights issue, previously the preserve of Eurozone banks. Now, Hornsea 3 is by far the biggest project Orsted has in development at some 3 gigawatts. When and if it is finished, it will be the world's biggest offshore wind farm. However, it is a project with very high execution risk in terms of funding and likely profitability, given that it was awarded by the UK government on record low subsidies, which the company has subsequently attempted to renege on and partially renegotiated higher with the new Labour government in 2004, before then pulling out of Hornsea 4. Now, we wrote in 2023 that we did not believe that Hornsea 3 would be profitable. Let me explain why. Hornsea 3 was struck at a record low subsidy of £37.5 per megawatt hour, which compared to Hornsea 1 at 140 and Hornsea 2 at 57.5. Now, Hornsea 3, being a later project, will also have a more difficult seabed site, which makes construction more difficult, and its turbines will likely suffer from wind wake. In other words, other turbines getting in the way of the wind, which will mean that its operating performance is less good. So with subsidies only 27% of the level of Hornsea 1 and 65% of Hornsea 2, in those projects which our analysis suggests are not themselves super profitable, we think Hornsea 3 is really going to struggle to make returns for its investors. Now, it's also curious that during this equity raise, Orsted suggests that despite Hornsea 3 being only 10% complete, that only £3 billion of capex is required post-equity raise to fund Hornsea 3 in its business plan. Now, we're scratching our heads about this because assuming typical UK North Sea offshore wind construction costs at £3.5 billion per gigawatt, a 2.9 gigawatt project should cost £10 billion. So this leaves £6 billion unfunded, or £3 billion if the company managed to find someone to farm down a 50% stake to, that would then have to fund also half of the project. And we think for various different reasons this is unlikely. So it's important to remember that the first claim to cash flow in individual projects is at the wind project special purpose vehicle level, where the wind farm has borrowed debt for its project below the Orsted group company level. And that Orsted's source of cash flow, rather than EBITDA, which it claims, can only come from dividends from these individual wind projects or from the sale of equity stakes in wind farms it terms as farm downs. So therefore, the cash flow that the parent company receives from its offshore wind projects is a fraction of the EBITDA it reports in its accounts, particularly as not many of Orsted's more recent projects pay dividends. So the cash generative projects at Orsted tends to be the ones that have been awarded a very, very high subsidy, that have no debt, but can pay Orsted therefore regular dividend. But many of the more recent projects have high debt in the project and also struggle to generate surplus cash beyond servicing their debt or amortizing their debt that will ultimately pay the parent company an equity dividend. Now, during the first half of 2025, Orsted burned through half of its remaining cash pile on its balance sheet, leaving just 12 billion Danish kroner at the interim level of the year. So at that rate of cash burn, all of the cash would be gone by the end of the year, and Orsted might run out of liquidity. So if I was Orsted's bank manager, I would be starting to panic, and he or she probably did. Now, Orsted has described the market for farm downs as a buyer's market, since valuations and the volume of transactions have markedly declined. But if Orsted is unable to farm down equity stakes to third-party investors in its projects, it will have insufficient cash flow not only to fund future projects, but also to service its group debt. And this is how Orsted could go bust. Now, during the recent Q2 conference call, unfortunately, Orsted's newest finance director couldn't give analysts an accurate net debt figure when asked. Now, we have some sympathy for this because the balance sheet is complex, but we believe that the Orsted underestimates its true debt level, and there is also hidden debt at the individual project level, and Orsted itself is a leverage play on already leveraged wind farm assets. Now, Orsted's capex commitments are staggering. It has committed investments of $25 billion over the next 3 years, $25 billion which is twice its current market cap, and the equity rights issue of just over $9 billion covers just over a year of capital expenditure. And as we have noted, a further $6 billion of Hornsea free capex is, in our opinion, unfunded by a business plan which seems aggressive in many of its assumptions. Now, Orsted generates minimal cash flow from its mature wind farms to fund this investment. The good wind farms, if you like, that still generate cash and pay dividends are very small in proportion to the development pipeline. So given the appetite in the farm down market, which Orsted is dependent on to recycle capital, is likely in our view to sour further, given Orsted's checkered track record, rising long bond yields, and in the UK rising political risk against offshore wind, particularly with reforms proposals. Even if the Sunrise project is bailed out by this rights issue, Orsted is likely to come back for more capital to bail out Hornsea free. So this rights issue won't be the last. It's just the first of what could be a series of rights issues to bail out the company. Now, in our opinion, Orsted is already insolvent. It doesn't have enough cash generating assets to service or repay its debt, and that the rights issue just gives it the liquidity to delay the inevitable. Orsted is utterly reliant on markets, both debt and equity markets, funding its business model. Now, Orsted's operational offshore wind assets are at best marginally profitable, but not after the cost of capital, i.e. depreciation, and they will struggle to upstream dividends when debt servicing cost is considered. The assets Orsted is currently developing are likely to be even less lucrative and subject to significant upward revisions in capital costs. The appetite of third-party investors to invest in Orsted's development has understandably diminished. Returns have not been good. Investors have soured on allocating to renewable energy, and Orsted's track record is now pretty checkered. And in the absence of dividends or farm downs, it's going to be the Orsted shareholders who are left, as the Americans will say, holding the bag. This 60 billion Danish kroner, or just over $9 billion rights issue, is not a one-time fix, but it is a classic extend and pretend. Orsted has become a woke money pit that equity investors are being asked to sustain purely for a non-economic agenda. It should be allowed to go bust. Let it go.